This is Nightly Business Report with Bill Griffith and Sue Herrera.
Bond beating. Stocks get trampled as the yield on the benchmark Treasury hits its highest level in 7 years, and mortgage rates follow. But is there opportunity here for investors?
Trojan horse, China reportedly installed a tiny spy chip to hack on U.S. companies, including some of the biggest technology names. Why this type of hardware hack is potentially devastating.
And huffing and puffing. E-cigarette maker Juul is fighting back against copycats as the government cracks down on the company. But the big winner could be big tobacco. All that and more on Nightly Business Report tonight for Thursday, October 4th.
And we do bid you good evening, everybody, and welcome. You know, there's an old saying on Wall Street that the bond market is smarter than the stock market. Now, whether or not that is true is not the point. What is the point is whenever a $100 trillion market has something to say, investors probably should listen. And it's talking right now, and loudly. Bond yields have been rising anyway recently, but this week yields have been spiking. And today, the benchmark 10-year Treasury did hit its highest level since 2011. And while rising yields can be a signal of a strong economy and therefore good for stocks, yields that rise too quickly could stoke fears that the Fed might have to raise interest rates faster to cool the economy. And that isn't good for stocks. And so today, stock investors seem to be listening to the bond market, and they were not happy. The Dow fell 200 points by the close to 26,627. It had been down more than 350 points at the lows of the day. The Nasdaq took the brunt of the selling, plunging by 145 points, or nearly 2%, and the S&P gave back 23. Bob Pisani puts it all into perspective for us tonight.
For months, trade wars have been the primary market focus, but the big mover today was bond yields, with rising rates sparking some concerns in the stock market. So what is the deal with the rising yields we've been seeing? Well, the first thing behind it is just strong U.S. economic data. It's been building for a while. We've had great numbers, but data on the U.S. services sector on yesterday, coupled with today's strong read on factory orders, caused the yield on the U.S. 10-year Treasury to shoot up. Second, the Federal Reserve is signaling higher rates. Fed Chair Jay Powell recently said very accommodative policy is no longer appropriate in the current environment. And while he advised the markets not to read too much into that, there's no denying that the Fed is reining in its stimulus. And finally, trade war fears are subsiding a little. Bond yields have been on a modest upswing since trade tensions began simmering down in early September, as investors have begun unwinding many of their big trade war plays, like buying into safe haven bonds. We've already seen stocks take a hit from higher yields today. Interest rate sensitive sectors have been generally down for the past month, even as the broader markets have hit new highs. So groups like home construction, real estate investment trusts, and utilities have all been down over the last month. The global bond yields have also hit multi-year highs. So this is not just happening in the United States. The question is, how far will it all go? We don't know, but in the past several days, volumes in widely traded bond ETFs have been the highest that we've been seeing in months. Bottom line, when a risk-free asset like treasuries have a big move like we've seen, traders sit up and they take notice. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
And that big jump in the 10-year Treasury yield has mortgage rates now at the highest level in 7 years. And as Diana Olick explains, that could not come at a worse time for buyers.
If you didn't lock in a mortgage rate last week, you're out of luck. Rates just took the biggest jump since November of 2016, the day after the presidential election, when bond yields surged. In just the past 2 days, the average rate on the 30-year fixed is up 14 basis points to now 4.94%, according to Mortgage News Daily. That's the average for borrowers with solid down payments and credit scores, so you're looking at 5% and above for the not-so-pristine borrowers. Rates are now a full percentage point higher than they were this time last year, the highest in more than 7 years. This comes in conjunction with still very hot home prices. The gains are shrinking slightly as sales slow, but prices are still rising faster than incomes, and in most major markets, home prices are already well above the last peak. So what does that mean for home buyers? About $180 more on a monthly payment for the median-priced house. And it's not just the payment, but lenders are strict on how much in debt payments you can carry versus your income.
As interest rates go up, you're going to have more people being declined for loans because they're not going to be able to meet all the criteria that's necessary. It's a bad combination of interest rates going up. At the same time, we're dealing with record high levels of home prices.
Friday could be an even bigger day in either direction for mortgage rates, depending on the outcome of the all-important September jobs report. For Nightly Business Report, I'm Diana Olick in Washington.
Now, one sector of the market that did well today were the bank stocks, especially the regionals. So what does this big jump in the 10-year mean for bank stocks? Is it time to own them? Joining us tonight is John Trainer. He's Chief Investment Officer at People's United Advisors. John, good to see you. Thanks for joining us tonight.
Thank you.
And you're not exactly here to make the case for banks as a long-term investment yet. Why?
You know, we tend to be students of history. And if you take a look at bank stocks, financial stocks in general, they tend to be early cycle stocks. The time you want to buy banks are at the bottom of a recession, and you generally want to start lightening as the Fed starts raising rates. Now, this cycle, because the banks were in the eye of the storm back in 2008, they really never had that early cycle run, so it's sort of been the lost decade for financial stocks. We think rising rates will certainly have a positive impact on bank earnings. So we could definitely see banks move up. But we own them, but we're not making a big bet on financials because we just think owning banks into a Fed increase cycle is generally a shorter term trade. So that 5-year hold we don't see in financial stocks.
All right, so let's take a look at what you would be buying at these levels if, for instance, you want to hold them between 3 and 5 years. Are there stocks that you think look attractive?
Well, the financial stocks that we own right now are the larger stocks, the Bank of America and JP Morgan, and in the regional space we own Key. They will all be beneficiaries of higher rates. You know, rates move up, that's great for bank earnings. And because we believe the economy will stay strong, as the economic reports of the last couple of days have said, credit quality should be good. So bank earnings should be very good. We're just not looking for that big secular rise in financial stocks at this point in the cycle.
All right, let me push back a little bit on that thinking because the banks did have something of a lost decade. They haven't enjoyed the rise in rates to this point. Why? I mean, Banking 101 says that when rates go up, banks make more money off the spread between what they lend and what they borrow, right? So why wouldn't they be a longer-term investment if we're, in fact, heading into a long-term trend of rising rates?
Really what impacted banks was this decade of, we'll call it free money, where the Fed had interest rates at zero. So banks, you know, they hit the floor on their cost for deposits, and we all saw deposit rates move down to zero. Rates came down also. The banks could not go to a negative rate. So even though rates came down, the economy did very well. That net interest margin, that's really the number that bank investors want to look at.
Right.
That net interest margin shrunk dramatically for banks, and that's what really held them back.
Yeah.
Very quickly, John, we only have a few seconds left. Why do you think the rate is increasing on the 10-year as quickly as it has been? Is it inflation? Is it a good economy? Maybe a combination of both?
Well, I guess there are two reasons that you want to look at for why the 10-year would be increasing. The bad reason would be a real inflation shock. You know, and your viewers can think back to the 1970s. That's a bad reason for rates to go up. The good reason, which is what we're seeing now, is this strong economy. So we think investors will do well in the market going ahead because rates are moving up because the news is good.
Before we let you go, clearly this doesn't benefit all sectors of the economy, those that are interest sensitive.
Yeah.
And today we saw that. I mean, utilities, that goes without saying, but real estate investment trusts also suffered today.
Yeah, we're underweight REITs, we're underweight the interest sensitive area, and we're also underweight emerging markets. Those are the two areas that we think are going to come under a lot of pressure going forward as you see rates move up. So we would remain underweight those areas.
And does this change the Fed at all? Very quickly, John.
Well, I think Jerome Powell came out yesterday, and part of the reason for the rise in rates was he came out and very strongly reiterated the fact that he thinks the economy is in good shape. Yeah. So I think, if anything, the Fed stays on course. What would scare us is if the Fed ever thought that they were behind the curve, if they got spooked and they said, boy, we need to accelerate the rate of increase. I think Chairman Powell has telegraphed very well, they're going to maintain this course, and they think they're in a good position. So we're pleased with that.
Very, very interesting. This feels like a watershed week in some ways. John Trainer,
absolutely,
with People's United Advisors. Again, thanks for joining us tonight.
Thank you. Thank you.
A U.S. judge found that Chinese telecom giant ZTE violated a probation imposed on the company last year. As a result, the U.S. is ordering the telecom equipment maker to undergo an additional 2 years of monitoring that will assess ZTE's compliance with U.S. export control laws. ZTE pleaded guilty in 2017 to illegally shipping products to Iran despite U.S. sanctions.
Elsewhere, Bloomberg is reporting that nearly 30 U.S. companies, including Apple and Amazon, may have been secretly subjected to surveillance by the Chinese government. Josh Lipton reports on what happened and the reaction from the potentially targeted businesses.
It reads like a chapter torn out of a spy novel. Chinese government agents infiltrating the supply chains used by some of America's biggest companies. That's what Bloomberg Businessweek is now alleging in an explosive report, saying that the Chinese military forced Chinese manufacturers to insert special chips into components that ultimately went into servers assembled by a company called Supermicro. Those sabotaged servers then made their way into data centers operated by dozens of companies. The apparent role of such implanted devices, opening doors that attackers could exploit, getting their hands on sensitive corporate information. But the supposed corporate targets of this attack dispute it. Amazon saying there are so many inaccuracies in this article as it relates to Amazon that they're hard to count. Apple saying each time we have conducted rigorous internal investigations based on their inquiries, and each time we have found absolutely no evidence to support any of them. And Supermicro emphasizing that it has never found any malicious chips, nor been informed by any customer that such chips have been found. But investors seem skeptical, sending Supermicro stock cratering, the market cap of the company dropping below $500 million. The story speaks to a broader issue. U.S. lawmakers have long been openly suspicious about technology assembled in China and then shipped to the U.S. for just this reason.
This is not something that was secret. It's been publicized. The U.S. government put out a comprehensive national cybersecurity initiative back in 2008. And in that initiative, one of the tenets of that, one of the major initiatives was the integrity of the supply chain. So this is something that certainly the government was aware of, the fragility and the potential vulnerabilities of the supply chain.
Today, Senator Mark Warner echoed that concern, telling CNBC this report provides more evidence that China's pattern of behavior is a serious threat to national security and supply chain risk management. Some tech analysts argue that if a security breach like this one turns out to be true, or one like it, American tech companies might indeed have to rethink how prudent it is to keep assembling their products in China. For Nightly Business Report, I'm Josh Lipton, San Francisco.
And let's pick up where Josh left off. Roger Cheng joins us now to talk more about China reportedly spying on some U.S. tech companies and what the implications are for this type of hardware hack. He is the executive editor at CNET. Good to see you again, Roger. Welcome back.
Thanks.
You know, as Josh laid out, the tech companies, some of them are pushing back on this report. But if indeed this did happen, what are the ramifications for these companies and how could they fight against it?
Yeah, if this report ends up being legitimate, I mean, the consequences here are devastating. Most cyber attacks are software-based, right? Inserting bits of code or using software or different codes to breach data systems. Having a system built around hardware, a hardware-based breach, is extremely rare, very difficult to pull off, but the sort of the long-term benefits for that hacker are potentially yielding a treasure trove of information for these for anyone looking to make this kind of move.
But I was struck, and I know you were too, and Sue mentioned this, the strong denials from the Amazons and the Apples and even the Supermicros. What do you make of those?
It's a rare move. Apple and Amazon in particular, are known for being fairly guarded when it comes to their public comments, and the fact that they came out with an official statement that they kind of broke down and dissected the story definitely caused me to take a closer look or a second look at that Bloomberg story. It's important to know, though, that Apple kind of hedged, and they did say that they did not find anything wrong with their servers. The story itself didn't actually say that. They never mentioned Apple discovering the chip, that it was other parties like Amazon. And it's important to note that Amazon has cut ties with Supermicro. So maybe they're leading on. Maybe they know more than they're leading on, but it is unusual that both Apple and Amazon came out so strongly against this article.
So maybe the truth is somewhere in the middle there. And if it is, do these tech companies have to rethink whether or not they produce some of their products in China?
I think whether or not this is valid, I think all these companies are looking up and down their supply chain, really seeing if there are any issues. There are, I guess, compliance. There are definitely checks now, but I think they're going to start looking and at least reconsidering the option of moving their supply chain elsewhere.
On that note, Roger, thank you so much. We'll continue to follow the story. Roger Chang with CNET.
Well, it's been a swing state in presidential elections, and now Florida may be the key for control of the Senate. And as always, it's about the economy. We'll head to the Sunshine State when we come back.
As you probably already know, health insurance is getting more and more expensive, and also for businesses. A Kaiser Family Foundation report shows the average cost of employer health coverage offered to workers rose 5% this year to nearly $20,000 for a family plan. And while employers pick up most of that tab, workers still average $5,500 a year in premiums. That is up 65% from a decade ago.
Well, Florida is always a key state during presidential elections, and this year the Sunshine State is a battleground for the Senate. The so-called I-4 corridor that runs through the central part of Florida is the swing region right now that will likely determine this year's race. John Harwood has more from Celebration, Florida.
The Democrats are going to become the majority in the House and the Senate.
The race here in Florida pits Bill Nelson, the longtime Democratic incumbent who touts his fights against Wall Street and insurance companies, against Rick Scott, the former healthcare CEO who's now Florida's Republican governor and trumpets the state's job growth. In a state packed with older voters, each uses Medicare to attack the other's background.
But career politician Bill Nelson doesn't think that rule applies to him. News reports reveal that Nelson doesn't pay payroll taxes for his employees. He doesn't even provide them with health benefits. It's stealing money from Medicare and Social Security, and it's unfair.
Rick Scott can't hide from the truth. He was CEO of a company fined $1.7 billion for Medicare fraud. He gave political donors secret contracts after Hurricane Irma that cost taxpayers $30 million. He cut education. He denied health care.
Scott claims credit for Florida's strong economy, and Republicans here agree.
We're making some good strides as far as, being able to new jobs and being progressive and getting back on track.
But Democrats have united in opposition to Trump and against his tax cut.
I really feel like it's a tax cut for the 1% and not for me.
I do. Now the battle over Trump's Supreme Court pick has introduced a new wild card. Anger among Republicans about a tax on Brett Kavanaugh. Nationally, pollsters show Republican enthusiasm rising, almost on par now with Democrats.
It's such a fraud issue.
The Kavanaugh hearings are a disgrace.
I don't think the liberal side, the Democrats, are doing themselves any favor with what's going on right now with this nomination, this Supreme Court nomination. I think it's a sham. I'm disgusted watching it.
Here in Florida and nationally, the question is whether that new Republican energy survives if the Senate confirms Kavanaugh to the Supreme Court. Still 4 weeks until Election Day. For Nightly Business Report, I'm John Harwood in Celebration, Florida.
Constellation Brands raises its earnings outlook for the year, and that's where we begin tonight's market focus. The company raised its guidance after saying steady growth in its core beers and wines business helped quarterly results top expectations. Constellation said there was especially strong demand for Corona and Modelo beers. The shares rose 5% to $222.10. Arrowhead Pharmaceuticals says it has entered into a nearly $4 billion license agreement with Johnson & Johnson's subsidiary to develop and market its hepatitis B treatment. Under the deal, Arrowhead will receive $175 million up front. It could receive more than $1.5 billion in milestone payments. Arrowhead may also be eligible to receive a separate $2 billion in milestone payments for 3 additional treatments. But that structure did not please the street. Arrowhead shares fell 17% to $15.33.
Oncology company Guardant Health began trading at the NASDAQ today after pricing its initial public offering at $19 a share. That valued the company at nearly $2.5 billion. Guardant has called its liquid biopsy blood test a game changer, saying that it is a simpler and less invasive procedure for patients with potentially cancerous tumors.
Lung cancer has been a really big application for us, but the technology is generalizable. It really works for all cancers. Today we're in late-stage disease, but where we're going is taking this technology, as we make it more sensitive, it can eventually be used for early detection for the rest of us. And that's really where the power and promise of this technology ultimately lies.
Well, look at shares. They popped 69% the first day of trading, closing at $32.20. And after the bell tonight, Costco matched Wall Street's earnings expectations and reported revenue that inched past estimates. But the discount warehouse retailer also warned that it expects to report a material weakness in internal controls relating to its IT systems that support the company's financial reporting processes. Shares initially fell in after hours and also finished down about a fraction at $231.68 today.
Coming up, why the government cracking down on e-cig maker Juul might be lighting a fire under the big tobacco stocks. As we've been telling you, the popularity of e-cigarettes has exploded among high school students. The FDA is cracking down on the industry leader, Juul. And as Aditi Roy tells us, that could have an unintended benefit for big tobacco.
They're sleek, slim, and stylish. That's one reason Juul's vaping devices are so popular.
It's one of those products that just flies off the shelf.
Juul has nearly 3/4 of the e-cigarette market, and now it's fighting back against copycat companies. Juul is asking regulators to order 18 companies to stop selling look-alike e-cigarettes. The company has filed a complaint with the U.S. International Trade Commission, alleging these companies, quote, blatantly emulated the distinctive design of Juul's system. Juul wants the agency to stop the products from being imported, distributed, sold, and marketed in the U.S. The company alleges copycat products include flavors like Bubble Bubble, apple juice, and sour gummy, which seem to target underage users. Juul itself is the focus of an FDA investigation into e-cigarette manufacturers and teen use of vaping devices. Just last week, FDA officials showed up at Juul headquarters and left with thousands of pages of documents. Juul CEO Kevin Burns says it provided the FDA with information about the company's online age verification protocols and calls its meetings with the FDA last week, quote, a constructive and transparent dialogue, adding that it's released more than 50,000 pages of documents to the FDA. The number of high school students who have used e-cigarettes in the past 30 days has skyrocketed by about 75%, according to people familiar with preliminary data from the CDC. The FDA is investigating whether Juul's sales and marketing practices have led to the increasing use of vaping products among teenagers. Juul has changed its ads from its early days, switching to a more sober tone with with older models. Juul's runaway success could also be cutting into sales of traditional cigarettes. Piper Jaffray points to a Juul survey of 19,000 Juul users, which found 62% were smokers when they started using the vaping device, and about 2/3 of them quit after starting to Juul. The one-year stock charts of British American Tobacco, Philip Morris, and Imperial Brands show shares of those companies down between 15 and 27% in the last 12 months since Juul's rise. But since the FDA's investigation into e-cigarette makers like Juul, shares of those companies appear to have rebounded. CB Insights reporting that tobacco companies are talking about vaping on earnings calls with increasing frequency, with British American Tobacco talking about vaping the most. Some of these big cigarette companies have launched their own vaping brands and are also part of the FDA's investigation. But given Juul's huge market share in the category and the fact that the big tobacco companies make all of their money in the higher margin cigarette business, analysts say they don't have as much to lose in an FDA crackdown. For Nightly Business Report, I'm Aditi Roy, San Francisco.
Finally tonight, bond billionaire Bill Gross put the first part of his U.S. stamp collection on the block last night, and the sale topped $10 million, making it the most expensive single stamp auction ever. Some of the highlights included the 2-cent blue Hawaiian, which went for $619,500, and the famed Bible block of unused 1847 stamps that were found in a Bible in the early 1900s. They went for $590,000. The rest of his U.S. collection will be auctioned off over the next year or so, and all proceeds will go to charity.
Wow. Before we go, here's a look at the final numbers on Wall Street. The Dow fell 200 points to 26,627. It had been down more than 350 at the lows of the day. The Nasdaq took the brunt of it, plunging 145 points, or nearly 2%. S&P 500 gave back 23.
Just thinking, what happened to my stamp collection? I don't know.
I never had one.
I have to look for it. That is Nightly Business Report for tonight. Thanks for joining us. I'm Bill Griffin.
I'm Sue Herrera. Have a great evening. We'll see you tomorrow.